It is not looking good for a lot of income strategy ETFs, such as ULTY. In this video, we're actually going to go over why now is probably the best time to sell these ETFs. Now, first off, a lot of these ETFs are down quite a bit. ULTY, as an example, is down 17.5% in the past month. Year to date, it's down 50%. Now, why would you want to sell an ETF such as this when we're near the end of the year and it's down so much? A lot of people don't really want to sell at a loss, but it's actually a really good strategy known as tax loss harvesting. Now, for people who are holding these ETFs and stocks in a tax deferred brokerage, such as a Roth IRA, they do not have to worry about this. But for people who are holding these ETFs, namely the income strategy ETFs, in a taxable brokerage, which a lot of us are because we are using these income ETFs to help supplement our lifestyle and using these dividends for expenses. And one of the main strategies that I've always explained on this channel is to actually diversify. You don't want to put your whole portfolio into these income strategy ETFs. You want to have a nice balance. Maybe you have some SCHD, maybe you have some SPY. So you have that diversification and you're not relying on these newer products from yieldmax, Roundhill, Defiance. These are very risky ETFs. So ULTY has lost a lot of its market cap because not only because of the share price, but a lot of people are transferring their funds from ULTY to some other ETFs. A lot of people are actually going back into SCHD, where this ETF is actually outperforming in the past week as well as past month. This has always been a stable, kind of slow and steady wins the race ETF, and it's kind of boring, which is why we've seen the craze this year going into a lot of these yieldmax funds where we're seeing 80, 90, 100% distribution rates. But in the long term, we know that many of these funds are not stable. Yieldmax has a ton of these single stock ETFs. I'm not a huge fan of. It's a huge risk because you're not really getting any diversification and you're also capping your upside potential because a lot of these income ETFs use covered calls pretty aggressively, which is going to limit your upside potential. And if you're in it for the long run, if you're in it for a growth ETF, these are not really the products for you. Or you could do somewhat of a hybrid. NEOS has some great products with QQQI and SPYI. These are going to allow for room for upside potential. We can see in the past year, it's up almost 4% while paying out a 13 to 14% monthly dividend. That 13 to 14% is annualized, but it does pay out monthly, which is pretty nice. So it's kind of giving you the best of both worlds. Not only are you getting high monthly income, but you're also going to get some room for upside growth. And it has done pretty well this year. It's up 5% year to date. But going over tax loss harvesting, you want to do this year. Now, say you have some realized gains from some other stocks or ETFs. This is going to help lower your tax bill when tax season comes around. So say you're not really a huge fan of MSTY or ULTY. I personally plan on getting rid of some of these ETFs and take advantage of tax loss harvesting opportunities. But say you're not really a huge fan of these ETFs. MSTY, for example, is down 30% in the past month. So a lot of people are at a loss in the share price for this ETF. Now, even though you may have a positive total return, including the distributions, this is just share price alone, and you can't really offset those distributions. But say your entire portfolio is inside an ETF such as MSTY, then how much can we tax loss harvest? Well, it says we can offset up to $3,000 of ordinary income in the current tax year. And if you have any remaining losses beyond that, you can carry them forward indefinitely into future tax years. So this is going to be very tax favorable for a lot of people who no longer want a certain ETF or stock in their portfolio. So it is going to help a little bit in benefiting you. Now, say you have $50,000 of capital losses. You can only offset $3,000 in that current tax year, but you're going to have about $47,000 carried forward. So say that following year you have a realized gain of $45,000, then that entire capital gains is going to be offset by your rollover capital losses, which is going to be something that is going to be very favorable for you, especially if you anticipate later on you are going to be in a higher tax bracket. But definitely take a look at your portfolio. Which ETFs are you no longer a huge fan of and are planning to sell? Let me know in the comments down below. But what also ETFs are you going to be buying? So some very popular picks, of course, we mentioned SCHD. A lot of people have not been a huge fan of. It's a slow and steady wins the race kind of ETF, but we've seen the share price alone is up 226%, and that's not including the dividends you're receiving. Now, even though it pays out a fairly low dividend yield of 3.8% and it pays out quarterly, this is a reliable dividend grower, and it's actually perfect for recessions. It's going to be pretty much recession proof compared to some of the other ETFs out there, namely the ones that are tracking the top tech companies, because those stocks are very volatile. They're at all-time highs, and right now market is kind of scared. We don't know what's going to happen with the economy, the job market. Everything is very uncertain. So for a lot of people are actually buying SCHD again. And personally, I may be adding a few shares as well. And if we take a look at SCHD year to date, the share price is pretty much flat at negative 0.48%. Now that looks pretty scary. Why would you invest in something that is losing to a high yield savings account? Well, that's just the nature of the game. Sometimes this fund will outperform. It just depends in the right type of markets. And especially with interest rates falling, it fell by about 50 basis points, and it's expected to fall even more. SCHD now becomes back on the table for its reliable dividends. And if you take a look at the total return year to date, it's actually a positive 2.38%. So it's not as bad as people think, but it is going to be quite reliable and steady. And if we take a look at the overall return since inception, which is 2011, we can see it has a whole total return of 407%. Now that is quite good compared to the share price alone, which makes up 226% of that. So dividends alone is going to be about 180% to your total returns. And if you're looking for something, you're a little bit scared of the recession, you're scared of the market, you can't afford to lose any more money, you definitely want to look into some safer options. As we mentioned, SCHD is a great ETF. We take a look at the holdings, very reliable companies. People are going to need these companies no matter what type of market. People are always going to be drinking Coca-Cola. They're always going to be needing gas. They're always going to need home supplies from Home Depot. And that is why SCHD has been so stable. Now, if you're looking for an income ETF, of course, we have some riskier ones. A lot of people were a huge fan of WPAY, but this is honestly a very volatile ETF. It's 1.2 times the leverage, and that is something people have to realize. But you are going to have some upside potential because it's not selling covered calls and it's using swaps in order to generate its premium and gain that leverage exposure. But if we take a look at the holdings, it's not very diversified. Most of its concentration is in the top tech companies. So if you are bullish on the top tech companies, definitely take a look at WPAY. It's been performing quite well for an ETF of this nature, and it's honestly going to be paving the way forward in order to have that upside potential in bull rallies, so you're not missing out on those gains. And I've been a huge fan of TLT for some time now, and with interest rates expected to fall, this ETF is going to be quite a reliable one in my opinion. You're going to be getting over a 4% dividend yield. It pays out monthly, and if interest rates fall, this ETF is going to rise in price, because when interest rates fall, this ETF now becomes more valuable because it's holding these 20 plus year treasury bonds in its portfolio. And another one you want to check out is, of course, NEO's S&P 500 High Income ETF SPY. You're going to be getting a dividend yield somewhere in the ballpark between 11 and 12%, paid out every single month. It's going to track the S&P 500 index, which is going to be the top 500 US companies. And we can see it has good share price appreciation. Now, of course, if the overall market falls, it's going to fall with it, but it's not going to lose nearly as much in value compared to just holding the S&P 500 because you are getting a dividend yield of 11-12%. And I know a lot of you love weekly dividend ETFs, but there really isn't a safe option for weekly payers. Now, of course, you have those money market funds, you have WEK, which is pretty much a high yield savings, but there's nothing that's going to be relatively safe, relatively stable. A lot of these are selling options. A lot of these are using these options on very volatile indices, such as the NASDAQ 100 or even single stock ticker ETFs, such as MSTY. You have HOOY. You're getting a lot of risk with these ETFs. Definitely take a look at stockanalysis.com, their weekly dividends list. There's over 113 ETFs. And if you are looking for a weekly paying ETF, definitely choose the one that is as diversified as possible. One that comes to mind would be XDTE, which is actually Roundhill's S&P 500 0-day to expiry cover call strategy ETF. And I picked this one because it is tracking one of my favorite indexes is the S&P 500. We can see it does fall in share price and it is using that cover call strategy. So it hasn't recovered since that April crash, but so far it's been paying out quite reliably. We can see in the past month it's up 3%. And it is giving you about a 20 to 30% dividend yield. So nothing crazy. It's pretty conservative for a weekly paying ETF compared to some of the ones out there, which are paying 80 and 90%. And it is going to give you weekly payout frequency. Another one is, of course, going to be YMAX. A lot of people really hate the yieldmax ETFs as of lately, but YMAX is going to be a pretty good one because it is diversified. It is going to be their fund of fund option income ETFs. So you are getting a little bit of diversification there, but it hasn't been performing too well in terms of share price. We can see it's been on a decline, down 33% year to date. I want to know from you guys. Let me know down below, what ETFs are you buying? Are you taking advantage of tax loss harvesting opportunities by selling some of your ETFs? Let me know down below, and thanks for watching.